Hello, welcome to Capital Sensei. Today, we're gonna dive into a fascinating book by Scott Nations called A History of the United States in 5 Crashes. We'll travel back in time to dissect 5 specific moments when the financial world seemed to fall apart. The Panic of 1907, the infamous Black Tuesday of 1929, the shocking Black Monday of 1987, the near collapse of long-term capital management in the late 90s, and the bizarre flash crash of 2010. Each one is a story of panic, innovation, and ultimately a hard-learned lesson. As we go through these events, you'll likely have questions. Whenever we can, we try to answer them in the comments. So please, feel free to share your thoughts, ask about anything that isn't clear, or even tell your own stories. Creating a community where we can all learn from each other is a big part of what we do here. Let's start our journey in a very different America, before the existence of the Federal Reserve. Imagine a financial system with no central referee, no big institution to step in when things go wrong. In the early 20th century, this was the reality. The banking system was a patchwork of state-chartered banks, and these things called trust companies. Trusts were like the wild, unregulated cousins of banks. They could take on more risk, and because of that, they often paid higher interest on deposits, which made them very popular. The problem with this system was confidence. It was all held together by belief. If people believed their money was safe, it was. But if a rumor started, if a single institution looked weak, that belief could vanish in an instant. This brings us to 1907 and a man named Augustus Heinze, a copper magnate with a taste for speculation. He and his brothers devised a plan to corner the market on the stock of a company called United Copper. Their goal was to buy up so much of the stock that they controlled the price, forcing other traders to buy from them at an inflated value. It was a bold move, but it failed spectacularly. Instead of the price soaring, it collapsed. This wasn't just a personal loss for the Heinze brothers. It was a public disaster. One of the trusts they were associated with, the Knickerbocker Trust Company, was immediately tainted by the failure. Depositors, fearing their money was at risk, lined up around the block to withdraw their funds. This is what we call a bank run. And in a world without deposit insurance or a central bank, a run could be a death sentence. The panic was contagious. It was like a single sick animal turning the entire herd into a stampeding mob. The failure of the Knickerbocker Trust made people doubt the stability of all trusts. Soon, runs were happening at other institutions across New York City. The entire financial system was on the verge of collapse. The dominoes were falling, and there was no official body with the power or the money to stop them. Enter John Pierpont Morgan, or J.P. Morgan. He was not a government official. He was an immensely wealthy and powerful private banker. Seeing the abyss, Morgan decided that if the government wouldn't save the system, he would. He gathered the presidents of the major banks and trusts in his library, a now famous setting, and essentially locked the doors. He told them in no uncertain terms that they were going to pool their money to prop up the failing institutions. It was an extraordinary moment, but private citizen acting as the nation's central bank, Morgan's plan worked. His group of bankers provided the liquidity, the ready cash that the system desperately needed to stop the panic. They chose which firms to save and which to let fail, effectively performing triage on the American economy. The crisis eventually subsided, but it left a huge lesson in its wake. A modern economy simply could not rely on the whims and resources of a single wealthy individual. No matter how powerful, the country needed a permanent, public institution to act as a lender of last resort. This realization directly led to the creation of the Federal Reserve System in 1913. Now, let's jump forward about 2 decades. The Federal Reserve exists, but the world is about to learn a new and painful lesson about speculation and debt. We're in the Roaring '20s, a period of incredible optimism. The war was over. New technologies like the automobile and the radio were changing daily life. And it seemed like everyone was getting rich in the stock market. It felt like the party would never end. A key ingredient in this market mania was a powerful tool called buying on margin. This is a form of leverage. Imagine you want to buy $10,000 worth of stock, but you only have $1,000. Your broker could lend you the other $9,000. Now, you control $10,000 of stock with only $1,000 of your own money. If the stock goes up 10% to $11,000, you can sell it, pay back the $9,000 loan, and you're left with $2,000. You've doubled your initial investment. What could go wrong? Well, what if the stock goes down 10% to $9,000? Now, the value of your stock is exactly equal to the amount of your loan. Your broker gets nervous. They don't want to lose their money, so they issue a margin call, demanding that you either put up more cash or they will sell your stock to cover the loan. If you don't have the cash, they sell. This forced selling pushes the stock price down even further, which can trigger margin calls for other investors. You can see how this creates a vicious cycle. In the late summer and early fall of 1929, the party started to wind down. The economy showed signs of slowing, and some big-time investors began to quietly sell their shares. A few bumpy days in the market made people nervous. Then, on October 24th, Black Thursday, a major wave of selling hit. A group of prominent bankers tried to pull a JP Morgan, pooling funds to buy stocks and show confidence. It worked for a day, but the fear was too deep. By the following week, the floodgates opened. On Monday, October 28th, and then catastrophically on Tuesday, October 29th, Black Tuesday, the market collapsed. The wave of margin calls became a tsunami. Everyone was selling, not because the companies were suddenly worthless, but because they had to. They were forced to sell to cover their loans. But ticker tapes that reported prices fell so far behind, they were useless. Panic ruled the day. The crash of 1929 didn't just wipe out fortunes, it shattered the nation's confidence and was a major catalyst for the Great Depression, a decade of severe economic hardship. The lesson here was brutal and clear. Excessive leverage and unchecked speculation create bubbles that inevitably burst with devastating consequences. In response, the government created powerful new regulatory bodies. The Securities and Exchange Commission, or SEC, was established to police the stock market and protect investors. The Federal Deposit Insurance Corporation, the FDIC, was created to insure bank deposits so that a run on one bank wouldn't create a system-wide panic. The rules of the game were changed forever. Let's fast forward again, this time by nearly 60 years to 1987. The world is different. We're in the computer age. The markets are faster, more global, and dominated by large institutional investors like pension funds and mutual funds. A new, sophisticated-sounding strategy had become incredibly popular: portfolio insurance. This sounds like a great idea, right? Who wouldn't want to insure their stock portfolio against a crash? But the way it worked was the key. It wasn't a traditional insurance policy. It was a complex computer-driven strategy that involved using stock index futures. The simple version is this. Managers would program their computers to automatically sell stock futures if the market fell by a certain amount. The idea was to cushion the blow of a downturn by selling ahead of further losses. The problem was that everyone started using the same strategy. All these computers were programmed with similar instructions. If the market drops by X, sell. On Monday, October 19th, 1987, a day that became known as Black Monday. This created a feedback loop from hell. The day started with heavy selling pressure, partly due to worries about interest rates and international tensions. This initial drop triggered the portfolio insurance programs. Suddenly, computers all over the world started dumping massive amounts of stock futures onto the market. This huge wave of selling in the futures market scared traders in the stock market, who then started selling actual stocks. This pushed the stock market down even further, which in turn triggered the portfolio insurance computers to sell even more futures. It was a terrifying, self-reinforcing death spiral, powered by automation. The Dow Jones Industrial Average fell by 508 points, a drop of almost 23% in a single day. To this day, it remains the largest one-day percentage drop in the market's history. It was so violent that some stocks couldn't even find a buyer at any price. The market's plumbing completely broke down. Unlike 1929, this wasn't really about margin calls from small investors. This was a crisis caused by a new technology that the market structure simply couldn't handle. The Federal Reserve, led by Alan Greenspan, learned the lessons of the past. It immediately announced it was ready to provide liquidity to support the system. The stock exchanges also took action, temporarily halting trading in some of the most volatile stocks to allow buyers and sellers to find each other. The crash was terrifying, but it didn't lead to a prolonged depression like in the 30s. The economy recovered relatively quickly. The main lesson? Automation and complex strategies can have dangerous, unintended consequences. This led to the creation of so-called circuit breakers, which are mandatory, market-wide trading halts that are triggered when prices fall too quickly. It's like putting an emergency brake on the entire market to give everyone a moment to breathe and prevent a purely computer-driven panic. Now we arrive in the late 1990s. The internet is booming, the economy is strong, and a new type of financial player is rising to prominence: the hedge fund. These were private, largely unregulated investment pools for the ultra-wealthy. And the most famous, most respected hedge fund of them all was a firm called Long-Term Capital Management, or LTCM. LTCM was run by a dream team of financial wizards. It included John Meriwether, a legendary bond trader from Salomon Brothers, and even 2 Nobel Prize-winning economists. These were, by all accounts, the smartest guys in the room. Their strategy was based on something called arbitrage. They used incredibly complex mathematical models to find tiny, temporary price differences between related securities around the world. For example, they might notice that a certain US government bond was a fraction of a penny cheaper than a nearly identical one. Their plan was to buy the cheap one and sell the expensive one, pocketing that tiny difference when the prices inevitably converged. This is like finding a vending machine that sells a can of soda for 99 cents and another one right next to it that buys it for $1. You could make a penny on every transaction. The problem is, you need to do millions of transactions to make real money. To amplify their tiny profits, LTCM used an absolutely breathtaking amount of leverage. For every $1 of their own capital, they had borrowed and invested over $25. They were picking up pennies, but they were doing it in front of a steamroller. Their models told them that the small price discrepancies they were trading were statistically certain to correct themselves. What their models didn't account for was a black swan event, something so rare and unexpected it breaks all the historical patterns. In August of 1998, that black swan appeared. Russia, a country they had invested in heavily, defaulted on its government debt. It was an event their models considered virtually impossible. Suddenly, the financial world panicked. Instead of behaving rationally and converging, prices flew apart. Investors fled from anything that seemed risky and piled into the safest assets like U.S. Treasury bonds. This flight to quality was the exact opposite of what LTCM's trades were betting on. Their small, risk-free positions started generating colossal losses. Because of their immense leverage, the fund was vaporizing. The problem was that LTCM was so big and had done business with so many major global banks that its failure threatened to bring the entire system down with it. They were too big to fail. If they defaulted on their loans and trades, the losses would cascade to their lenders, Goldman Sachs, JP Morgan, and nearly every other major name on Wall Street. It could have triggered a global financial meltdown. The Federal Reserve Bank of New York had to step in, but this time they didn't use public money. Instead, the Fed brokered a deal. They gathered the leaders of 14 major financial institutions, the very banks that were exposed to LTCM, and orchestrated a private $3.6 billion bailout. Essentially, the banks had to bail out their own client to save themselves from a catastrophe. The lesson was chilling. Financial brilliance and complex models are no match for human panic. And the interconnectedness of modern finance meant that the failure of one obscure hedge fund could endanger everyone. This was a dress rehearsal for the even bigger crisis that would arrive 10 years later in 2008. Our final stop is May 6, 2010. The world is still recovering from the great financial crisis of 2008. The markets are on edge, and they have become a completely different animal. Trading is now dominated by high-frequency trading, or HFT. Think of this as portfolio insurance on steroids and caffeine. Powerful computer algorithms housed in data centers right next to the stock exchange's own servers were now making millions of trades per second. The goal was to be faster than everyone else, exploiting tiny price movements that last for only milliseconds. On this particular afternoon, the market was already down a bit for the day, driven by worries about the Greek debt crisis. Then, around 2:42 p.m., something snapped. In the space of about 5 minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, representing about $1 trillion in market value, before inexplicably rocketing back up again. It was the flash crash. Traders watched their screens in stunned disbelief. For a few terrifying minutes, it looked like the end of the world. Then, just as quickly, it was mostly over. What on earth happened? For months, nobody was quite sure. It was a genuine mystery. Investigators eventually pieced together the story. It started with a single large sell order. A mutual fund, Waddell & Reed, wanted to sell a $4.1 billion position in E-mini S&P 500 futures. They used an automated algorithm to execute the sale. But the algorithm was a bit dumb. It was programmed to sell that massive amount based on volume, not price or time. It just kept feeding sell orders into the market. This huge, relentless wave of selling was met by the high-frequency trading algorithms. The HFT bots are designed to provide liquidity, but also to protect themselves. Seeing this one-sided pressure, they did what they were programmed to do. They vanished. They pulled their buy orders and in some cases started selling themselves to get out of the way. It was like a crowded room where one person yells, "Fire!" and suddenly everyone sprints for the same tiny exit. The market's liquidity, the willingness of buyers to buy, evaporated in seconds. The result was a vacuum. With no buyers, prices went into freefall. Stocks of major, stable companies like Accenture and Procter & Gamble traded for a penny. The market's structure, now dominated by machines talking to other machines, had become incredibly fast, but also incredibly fragile. The flash crash showed that humans were no longer in moment-to-moment control. The lesson from 2010 was that the very plumbing of the financial markets had changed. The race for speed had created new, unforeseen risks. In response, regulators implemented new rules, including an updated version of the circuit breakers, this time for individual stocks, and a new system to help consolidate market data to make it easier to see what's happening across different exchanges. But the event served as a stark reminder that as our technology gets more complex, so do the ways it can fail. So, what do we take away from these 5 stories? Each crash was born from a unique combination of human behavior and the technology of the day. In 1907, it was unregulated trusts and a reliance on one man's wallet. In 1929, it was widespread public speculation fueled by easy debt. In 1987, it was a new computerized hedging strategy that everyone adopted at once. In the late 90s, it was the hubris of brilliant minds using extreme leverage. And in 2010, it was a market of machines that outran their human masters. Each crisis forced regulators and market participants to evolve. The Federal Reserve, the SEC, the FDIC, circuit breakers, these are the scars left behind by past failures, designed to prevent the same mistake from happening again. But here's the crucial insight. The next crisis rarely looks like the last one. Human nature, that potent cocktail of greed and fear, remains constant. And our relentless drive for innovation, for a new edge, means we are always creating new, untested tools and strategies. Understanding this history is not about learning to predict the exact date of the next crash. No one can do that. It's about recognizing the patterns, the buildup of leverage. The widespread belief that this time is different, the introduction of a new financial product that no one fully understands. It's about building a personal financial plan and an investment portfolio that are resilient, that can withstand the storms that will inevitably come. The history of crashes is a history of lessons, and for an investor, those are the most valuable lessons of all.